Have you ever wondered how people make money in trading currencies online? For sure you heard about Forex in so many people, it is just that you have little knowledge about it. In today's video, we will learn about trading currencies in the Forex market, which considered the largest market in the world. This full course about Forex trading is brought to you by SoxTrade PH. Empowering people through financial literacy. Subscribe now for more free tutorials. Forex trading, also known as foreign exchange trading or currency trading, is the buying and selling of currencies on the foreign exchange market. It involves the simultaneous purchase of one currency and the sale of another, with the aim of profiting from fluctuations in exchange rates. The foreign exchange market is the largest and most liquid financial market in the world, where currencies are traded 24 hours a day, 5 days a week. Participants in the Forex market include banks, financial institutions, corporations, governments, and individual traders. Forex trading is typically conducted through a broker or a financial institution that provides access to the market. Traders speculate on the future direction of currency pairs by analyzing various factors such as economic indicators, geopolitical events, interest rates, and market sentiment. Forex trading offers a wide range of opportunities for traders to profit, whether the market is rising or falling. Traders can take buy or sell positions on currency pairs, depending on their expectations for the market. Profits are generated by buying low and selling high. It's important to note that Forex trading carries a significant level of risk, and it requires knowledge, experience, and discipline to be successful. Traders should educate themselves about the market, develop a trading strategy, and carefully manage their risk to increase their chances of success. The Forex market operates 24 hours a day, 5 days a week. It is a decentralized market, meaning that trading occurs continuously across different time zones around the world. The market opens on Sunday at 5 p.m. and closes on Friday at 5 p.m. New York time. If you are in Hong Kong or Singapore, the market opens at 5 in the morning Monday and closes on Saturday 5 a.m. The Forex market is divided into 3 major trading sessions. They are: Asian session. This session starts at 6 a.m. and ends at 3 p.m. Singapore time. The major financial centers during this session are Tokyo, Hong Kong, and Singapore. European session. This session begins at 3 p.m. and concludes at 12 midnight. The key financial centers in this session include London, Frankfurt, and Zurich. North American session. This session starts at 8 p.m. and ends at 5 a.m. The primary financial centers during this session are New York and Toronto. There is some overlap between these sessions, which can result in increased trading activity and liquidity. Additionally, certain currency pairs may exhibit more volatility and liquidity during specific trading sessions. Traders and investors often consider these factors when planning their trading strategies. The major currencies in the Forex market are the most widely traded and influential currencies. They are United States dollar, euro, Japanese yen, British pound sterling, Swiss franc, Canadian dollar, Australian dollar, New Zealand dollar. These currencies are considered major because they have the highest trading volumes and are involved in the most significant Forex transactions worldwide. Other currencies, known exotic currencies, are traded less frequently. A currency pair in the context of Forex trading refers to the 2 different currencies that are being traded against each other. The value of a currency pair is determined by the exchange rate between the 2 currencies. Currency pairs are always quoted in relation to one another, with the first currency in the pair being the base currency, and the second currency being the quote currency. For example, in the currency pair EUR/USD, the euro is the base currency, and the US dollar is the quote currency. This means that €1 is equivalent to this in USD. There are 3 main types of currency pairs being traded in the Forex market. They are major pairs. These pairs consist of the major currencies in the world, including the US dollar. Examples of major pairs are euro with the US dollar, British pounds with the US dollar. Minor or cross pairs. These pairs do not include the US dollar as either the base or quote currency. Instead, they are formed by combining two major currencies other than the US dollar. Examples include euro and British pounds, Canadian dollar with the Japanese yen. Exotic pairs. These pairs involve one major currency and one currency from an emerging or less traded economy. They are typically less liquid and have wider spreads compared to major and minor pairs. Examples include US dollar against the Philippine peso, US dollar and Singaporean dollar. Leverage in Forex trading refers to the practice of borrowing funds from a broker to increase the potential returns on an investment. It allows traders to control larger positions in the market with a smaller amount of capital. I will first make an explanation if you will trade without leverage. Let's say you have $500 in your trading account and you've decided to use all of it to buy the British pounds at the exchange rate of 1.25. That means you bought £400 from this transaction. Within the day, the exchange rate rose to 1.26 and you closed the transaction. Closing the transaction means you are exchanging the £400 that you bought back to the US dollar, but at this time, at the price rate of 1.26. With that exchange, you received $504 and the $4 is your profit. Leverage is expressed as a ratio, such as 150, 1 to 100, or even higher. The higher the leverage ratio, the greater the trading power you have, but also the higher the risk involved. While leverage can magnify profits, it can also amplify losses. Let us say your broker gives you 1 to 400 leverage. That means for every dollar you have in your trading account, you can control $400 in the market. Therefore, with your $500, you can trade a position of $200,000. That is 400 times larger. Going back to your trading account of $500, you have decided to use all the possible leverage from the broker of 1 to 400 ratio. From the exchange rate of 1.25, you were able to buy £160,000. Within the day, the exchange rate rose to 1.26 and you decided to exchange the £160,000 back to the US dollar at the price rate of 1.26. In this transaction, you will receive $201,600. The broker will take back the $200,000 loan and will leave you with the $1,600 profit. It will be added automatically to your account balance. PIP is an acronym for percentage in point. It is the unit of measurement in Forex trading, meaning the movement in the exchange rate is measured by pips. Most currency pairs are quoted to 4 decimals. Example, Euro US dollar. The buy rate is 1.1273. If the price moved to 1.1274, the price of the currency pair has increased 0.0001, or simply say 1 pip. Here's another example. Let us say you are trading British pounds against the dollar. You are selling at the rate of 1.2565. Within the day, the price moved to 1.2586. This means the price has increased 0.0021, or simply say 21 pips. It is always 2 decimals for currency pairs with the Japanese yen. Example, the price for the currency pair USD, JPY right now is 130.55. If the price fell to 130.54, the price has decreased 0.01. Or simply say 1 pip. Almost all brokers now are offering fractional pips. Fractional pip is the tiny number that you can see after the 4th decimals, or the tiny number after the 2nd decimal for pairs with the Japanese yen. Let us take a look at this price movement. You can see the pair Euro USD rate is moving from 1.12723 to 1.12745. If we will calculate the changes, the price moved 0.00022, or 2.2 pips. To calculate your profit and loss in Forex trading, you need to consider these factors. 1. Currency pair. 2. Trade size. 3. The entry price. 4. The exit price. We must always check what currency pair we are trading, because different quote currency means different calculations. Let us take this as an example. GBP, USD. The base currency is GBP and the quoted currency is USD. Meaning, either we click buy or sell in the trading platform, we buy and sell the base currency. And the profit and loss is according to the quote currency, which is in this case, the US dollar. Let us say you click buy GBP, USD for 50,000. That means you are buying 50,000 worth of British pounds. For this example, we will have the entry price 1.2500. After 2 hours, the rate for GBP, USD has risen to 1.2545 and you close the trade. In this scenario, the price moved 0.0045 or 45 pips. The calculation is like this. Price movement, which is 0.0045, multiply it to the trade size, which is 50,000. Since the price of the GBP has risen and you clicked buy, you have earned 225 United States dollars. Why USD? Because it is the quote currency. Let us try calculating with a different quote currency. In this example, let us say you sell USD, JPY for $50,000 at the entry price of 120.55. After an hour, the price fell to 120.35 and you closed the trade. The price movement for this scenario is 0.20 or 20 pips. We will multiply the price movement, which is 0.20, to the trade size, which is 50,000. You have gained 10,000 Japanese yen because the price value fell and you sold it at the highest price. Since your trading account with your broker is in US dollar, the platform will automatically convert it to the latest exchange rate. In this scenario, you have earned $83.13. Spread is the difference between the buying and the selling price. It is normally measured by pips. Whenever you hear your broker saying that the spread for Euro USD is 2 pips, it means the difference is 0.0002. Brokers earn from the spread. They normally don't charge commissions because they are already earning from the price difference. Here's how spread works in Forex trading. Let us say you have decided to trade GBP, USD. This is the rate for buy and sell. You are expecting the British pounds to rise in value, so you have decided to buy it. You have a $1,000 account with your broker and they are offering 1 to 400 leverage. With your $1,000 you can trade as much as $400,000 but have decided to just use a quarter of it. So you used $100,000 to buy the British pounds at 1.2500 and you received £80,000. After how many hours? The GBP USD rate changed to this and you decided to close your trade. Since what you have now is the British pounds, we will not check the buy price because we cannot buy GBP with another GBP. But instead, we will check the sell price because we will be selling the £80,000. From this trade, the movement was 33 pips and we will multiply it to 80,000. The profit is $264. Supposed to be, the profit is $280 because you bought GBP and the buy rate as of now is 1.2535. But because of the spread, the broker will give you the selling price instead of the buying price. The $16 difference is the broker's profit from this transaction.